Hello everyone. Today we're going to speak about how bonds are different than equities. While choosing between bonds and equities can be a tough decision for investors, each has its own benefits and risks. We'll break down the key differences to help you decide what's best for your investment goals. First, let's understand what are bonds. Bonds are basically loans you give to corporations, municipalities, or governments. In return, you get a regular interest payment and your principal back at maturity. Now, what are equities? Equities represent ownership in a company. When you buy stocks, you essentially own a piece of the company, earning dividends and potentially profiting if the stock price goes up. Now let's understand how bonds and equities work in India. Bonds are issued by the government, corporations, or municipal bodies. Bonds provide regular interest payments and can be traded before maturity. However, bonds typically have higher liquidity risk compared to equities. Equities are traded on stock exchanges like NSE and BSE. Equities offer returns through dividends and capital appreciation. They can be bought or sold easily, offering higher liquidity but also higher risk. Next up, what are the types of bonds in India? Government bonds, which have low risk and are backed by the government. Corporate bonds have higher returns but with more risk. Municipal bonds come with moderate risk and sometimes with tax benefits. Tax-free bonds are issued by entities like NHAI with interest income exempt from tax. Furthermore, what are the types of equity in India? Blue chip stocks are stable, large cap companies like Reliance or TCS. Mid cap and small cap stocks have higher growth potential but are more volatile. Dividend stocks give regular income through dividends. While equity mutual funds and ETFs are diversified stock portfolios and are managed by professionals. What are the benefits of investing in bonds versus equities? Bonds offer stable returns, capital preservation, tax benefits, making them a safe choice to conservative investors. Equity, on the other hand, provides potential for higher capital appreciation, dividends, and easy liquidity, ideal for growth-oriented investors. Now, what are the risks involved while investing in bonds versus equities? Bonds include risk like credit risk, interest rate risk, inflation risk, liquidity risk, and reinvestment risk. While equities include risks like market risk, company-specific risk, volatility, economic and regulatory risks, and currency risk for the international stocks. Now let's compare the returns in India. Bonds offer lower but more stable returns. Corporate bonds might offer higher returns than government bonds, but with added risk. Equities have historically delivered higher returns, but with more volatility and risk. How do you choose between bonds and equities? Higher risk tolerance? Equities might be your go-to. If you prefer stability, bonds are better. Second is investment horizon. Looking for a short-term tenor? Bonds might suit you better. For long-term, equities are better for growth potential. Income needs. Need regular income? Bonds are ideal. Looking for growth? Equities are the way to go. Diversification. A balanced portfolio of both bonds and equities often work the best, with allocations based on your risk appetite. Making the right investment choice depends on your personal financial goals and risk tolerance. Whether you choose bonds, equities, or a mix of both, understanding these basics will help you make informed decisions. If you find this video informational, do like, subscribe, and hit the bell icon for such content.